You finally get that promotion you've been chasing. 6 figures, $100,000 a year. On paper, it feels like you've reached financial freedom, but the end of the month tells a different story. When you look at your account balance, there's a low-grade, nagging anxiety. You are earning top-tier money, yet you are still living paycheck to paycheck. You are not necessarily making bad decisions. You are budgeting and working hard. The issue is that the math governing modern life has changed significantly over the last 2 decades. A $100,000 salary now requires constant, active oversight. Between high taxes and rising fixed costs, the surplus can disappear before you have a chance to save. If you build your life around financial advice from 20 years ago, you will fall behind. The cost of participating in the modern economy has risen faster than most salary brackets. To understand where the money goes, we need to track a $100,000 salary category by category to see what actually survives. The first step is acknowledging that gross income is a deceptive metric. Your net take-home pay is the only figure that determines your actual ability to pay bills. This requires focusing exclusively on the amount that arrives in your bank account. That net figure determines your buying power, regardless of what is written on your contract. This chart tracks exactly what happens to your salary. Before you touch a single dollar, the government takes its cut through federal and state income taxes. After standard deductions, a single filer in the U.S. is left with take-home pay around $72,000 to $75,000. If you live in a high-tax state like California or New York, you might clear in the mid to low 60s. This reduction is a standard reality across Western nations. In the UK, income tax and national insurance reduce a £100,000 salary to the low 60s. Canada shows a similar trend, with provincial and federal taxes taking roughly a 30% bite. Every budget and lifestyle choice must be anchored to this net number. While the $100,000 figure remains your gross total, the $65,000 to $75,000 take-home is the only amount available for your expenses. Housing is your largest unavoidable expense. Following the traditional 30% guideline for gross income, provides a $2,500 monthly budget for shelter. In major metropolitan areas like Austin, Denver, or Toronto, $2,500 a month secures a modest, mid-tier one-bedroom apartment. For those who own a home, property taxes, HOA fees, and annual maintenance push these costs further. A modest family home can easily require $4,000 to $5,000 a month in total carrying costs. The second largest deduction goes toward getting around. For most earners, a vehicle is a functional requirement for maintaining their employment. When you combine an $800 car payment with insurance and $7.49 for a gallon of gas, the costs add up. Operating a single vehicle now costs between $800 and $1,300 every month. Shelter and mobility can consume over half of your actual take-home pay. This forces you to carefully prioritize your location and vehicle choices to maintain any monthly surplus. Next is the cost of food. Grocery prices have risen 30% to 40% recently. $6.99 for bacon is now common. A standard household often spends $800 to $1,200 a month just on basic supplies. Using delivery apps adds a heavy multiplier to these costs. Service fees, surge pricing, and tips can easily triple the price of a single meal compared to cooking at home. Then there is the cost of insurance, which is a frequently underestimated category in household budgets. For a family in the US, health premiums, out-of-pocket medical costs, dental, auto, and home insurance can represent $2,000 to $4,000 in monthly outflows. This is a major point of difference between systems. In the UK, the NHS covers the majority of healthcare costs, which removes a significant financial burden from the monthly baseline. Comprehensive insurance limits your monthly cash flow, but it provides the only protection against financial catastrophe if you have limited savings. Smaller, invisible drains also play a role. Streaming services and digital storage fees can silently accumulate into $400 to $600 of monthly spending. Higher income also leads to lifestyle inflation. You might choose a nicer apartment or organic groceries, adjusting to a higher baseline of comfort until the extra money is fully absorbed. Debt acts as a persistent drain on your income. Student loans and car payments frequently consume 10% to 20% of net pay before the month even begins. Credit card balances and installment plans carry high interest rates that directly reduce your ability to build wealth. These payments consume the margin you need for long-term stability. Upgraded lifestyle choices and minor conveniences can eliminate the financial breathing room that a $100,000 salary was expected to provide. The chart shows the final result. When you stack housing, transport, food, insurance, and debt, a $100,000 earner often has $5,000 to $9,000 in monthly expenses against a $6,000 take-home pay. This math assumes a month with no surprises. It does not account for home repairs, medical emergencies, or contributions to retirement savings. If 6 figures feels tight, your assessment of the situation is accurate. The cost of living has simply outpaced the growth of the salary. Relying on a high gross income to automatically generate a surplus is no longer a viable strategy. The numbers do not support that assumption. Regain control through consistent measurement. Early in your career, tracking take-home pay and capping lifestyle upgrades is your primary defense. For established families, prioritize locking in fixed costs. Securing housing and insurance payments first creates a stable foundation for the rest of your budget. To maintain solvency in the 2026 economy, you must look past the prestige of a 6-figure salary. Measuring your actual net income and prioritizing essential expenses is the only way to achieve financial stability.